U.S. Federal Reserve keeps its word, the great balance sheet unwinding is set to begin in October as the central bank left its key rates unchanged in its meet this week. As expected, the reduction of the $4.2 trillion balance sheet begins next month, and the Fed also hinted at another rate hike by the end of the year, despite flagging off low inflation concerns. Since the outcome was nearly priced in, the U.S. markets were little unchanged by the end of the day, while the dollar and bond yields rose. Yellen also acknowledged that the fall in inflation remains a bit of a mystery, but added that the economy is robust enough to withstand further rate hike. She argued that the ongoing strength of the economy and the labor market would help ultimately lift the inflation, but kept open the possibility that the central bank would alter course if that proved not to be the case.
My colleagues and I on the Federal Open Market Committee decided to maintain the target range for the federal funds rate at 1 to 1.25%. This accommodative policy should support some further strengthening in the job market and a return to 2% inflation, consistent with our statutory objectives. We also decided that in October, we will begin the balance sheet normalization program that we outlined in June. This program will reduce our securities holdings in a gradual and predictable manner. Overall, we expect that the economy will continue to expand at a moderate pace over the next few years. In the third quarter, however, economic growth will be held down by the severe disruptions caused by hurricanes Harvey, Irma, and Maria. We anticipate that core and headline inflation will move up close to our 2% objective next year, namely that this shortfall this year is due to transitory factors that are likely to disappear over the course of the coming year.
I think if you wanted to find one dovish element to what the Fed announced, is if you look at the long-term forecast, the summary of economic projections, there is a decrease in the range that was forecast in terms of the longer-term Fed funds rate. So again, yet another indication that perhaps the neutral rate in the future is not as high as people had thought in the past, which could be a comfort to people thinking about financial asset valuations looking forward.